So welcome again and good morning, everyone. Thank you so much for being here as we talk public service loan forgiveness for the VCU community. My name is Carolyn McCrae. I am the Director of Financial Wellness here for the Financial Success Center at VCU, and it is my pleasure to introduce these two fine folks with me today who are going to be sharing all of their expertise about public service loan forgiveness. So first, we have Scott Kemp, who serves as the student loan advocate in the Office of the Qualified Education Loan Ombudsman at the State Council of Higher Education for Virginia, or SCHEV. Prior to this position, Scott served as interim VP of Student Services, a state director for the high school career coach program, a community college civil rights compliance coordinator, a K-12 state career specialist, and a school counselor. So quite a few roles under his belt related to just expertise in education. His career has focused on helping students and those who work with students on their career pathways to success. Scott received his bachelor's from the University of Virginia, master's degrees from Hollins College and Catholic University, and an education specialist degree in higher education from Old Dominion University. Welcome, Scott. Thank you so much for being here with us today. We also have Jesse McMillan, who serves currently as the Senior Associate Director of the Office of Financial Aid here at VCU. He has been with VCU since 2020 and has over 8 years of experience in financial aid. He has a Master of Taxation from Capital University Law School, a Master of Science in Applied Economics from Southern New Hampshire University, and his Bachelor's in Economics from Bowling Green State University. So this man knows a thing or two about numbers. Jesse is passionate about college accessibility and affordability, and he is here today to provide his expertise because he works with financial aid for current college students. And he is also currently navigating the PSLF process himself, and he will provide his insights and recommendations from the user experience side of things. So welcome, Jesse, and thank you so much for being here today. We're going to turn it over to Scott first, who is going to give us a presentation, and then we will have plenty of time to hear from Jesse about the user experience side of things and leave enough time to answer your questions as they come in. So again, use that Q&A function to submit questions, and we'll make sure that we address as many as we can in our hour here together. So Scott, I'll let you take it away.
Thank you, Caroline. I appreciate this and appreciate the opportunity to talk to you about this exciting topic. It seems to be changing every day on what it's doing, how the federal government is managing the program, which is a great option for public service employees, both at the local, state, federal government level or nonprofits. And they've made some changes this summer in the past year that made it easier. So I'm hopefully to kind of sort through it. Before I do, I just want to do a quick overview of my office. I mean, when my title gets introduced in the office, I mean, it's a handful to get it all out in one breath. But essentially, I've been on the job almost 4 years and was hired to do three main things. One is working with borrowers like you, and that's the majority of my time spent doing that. The second was to create a qualified education loan borrower course that I'll give you a quick preview of it. And then also just kind of collect data, make policy recommendations. And some of the recommendations we made, myself and the other state advocates, included like making some of the fixes to PSLF that are now being implemented. So it's good to see that the fruits of our action are finally coming forward. Well, just real quick, we have a loan course that is geared toward three target audiences. Those are future loan borrowers, and the information is kind of packaged in not just about student loans, but about financial aid in general, and to understand student loans in that context. So if you have anybody that you know is in high school thinking about starting college, worried about financing, we've got some good modules on there. We also have modules for current students who are beginning to start the repayment plan process, and then also mainly for those in loan repayment. And just a quick, it's virginiastudentloanhelp.org. We tried to come up with a catchier and flashier URL for it, but we just decided, you know what, let's be obvious and just spell it out the way that it is. And so it's got interactive videos, some quizzes you go along, some calculators. So, you know, again, it might provide some good information. You can see all the different modules that we have. And we kind of did it 100, 200, and 300 level, depending on where you are. And you'll see we do specifically have a loan module for PSLF, but also some others. And again, I encourage you to either look at it or feel free to share it with anyone. We're kind of done a soft launch on it. We're about to do a press release about it, just to get people some good information about that. But specifically as relates to today's topic, we have a direct link to the PSLF, virginiastudentloanhelp.org/PSLF, and it'll take you right to that module. So if I talk too fast and I give too much information and you want to go back and review some of the information, you're welcome to check this module out or to share it with anyone else about it. So it's just some good information. And we kind of created it so that has some other modules about spending, budgeting, income and expenses. And we're really hoping that people, we're hoping to build a relationship with high school students as they're taking that economics and personal finance course that they have to take for graduation, to start this portfolio and then kind of keep continuing to access the information on the site as they progress on through all their decisions, both how to fund their education, but also, how to get a mortgage, how to get a car loan. So just kind of package all of that within the context of all the expenses that they have. You've also noticed that, I took out my loans back in early 90s and, it's changed a lot. And most recently, federal student aid has put some very helpful information on their website, including like a loan simulator. So when people ask, what are the best pieces of advice I can give? And one is that educate yourself. Now, your loan servicer is still the one that handles your repayment plan, does a lot of the loan forgiveness. They're moving away from your loan servicer being the primary point of contact and moving towards federal student aid to being the place that you enter. And in fact, they even now have like an interactive, their version of Siri, it's called Aiden, who, you can type in your question. And once you've logged in with your studentaid.gov account, and that's that FSA ID that you initially created when you filled out the FAFSA, that's still active. If you don't remember what it is or your password, there's some account recovery tools. Once you're logged in, it knows everything about your account. And you can type in a question and saying, what are my loan options? Or who is my loan servicer? And it'll take you right there. But this loan simulator is good because you tell it what your repayment goal is. Now, I check the box, pay the lowest total amount over time, because that's the objective of the PSLF program, is you want to pay as little as possible to have the most amount forgiven at the end of your 120 months of service that you've done. And just to kind of give you an example of what it looks, I looked at, the average four-year graduate coming out is about $27,000 is their income. So you put in what your salary is, you can see what the standard repayment is, and there is even a box that you can check that says you're working towards PSLF. So it'll only give you the repayment plan options that qualified for PSLF. And you can see, the amount that you would pay over time. And this is assuming like a 3% annual increases in income. So just again, before you call your loan servicer, my suggestion is to kind of educate yourself, know what your options are. So when you get on there and they only give you one option, you can say, well, what about, repay, or what about, income-based repayment? Make sure that they give you all their options. The other piece of advice I can give you in working with borrowers who have had loans for 20, 30 years, avoid interest capitalization the best that you can. I have borrowers with 20-year-old loans that owe more than when they started. And I just had a case where a borrower, I think she took out like $2,600 back in 89, 30 years ago, and she still owes about $2,000. And it's this interest capitalization. It is very damaging. So if you ever get to the point or somebody who is struggling with their loan payments, and that's happened a lot during the pandemic, definitely make sure that they go towards the income-driven repayment route rather than going into forbearance, because there even if your income is low enough, there are some options where, like the first 2 years of payments, you make a $0 payment and the government pays the interest on it. So after 2 years, once you get your feet on the ground, get your better sense of your finances, and you can start making those payments, you're where you were 2 years prior with your loan amount. So just some helpful information about that. Okay, so what has the pandemic done to loans? I started in October 2018, and it's the first year and a half, everything was going fine, then all of a sudden the pandemic hit. And, they made a good decision to put student loans on hold. But there were a lot of caveats to it. It was just federally held loans. So if you have older loans, like prior to maybe 2007, called FFEL, the Federal Family Education Loan Program, some of them were owned by the federal government, some were owned by private. The private didn't count, so there was a lot of confusion early on. But essentially, all of the loans, federally held loans, were put into administrative forbearance, which means whatever your loan amount was in March 2020, when it restarts in September, it should be the same amount. And I would encourage you to double check that. It will, as of right now. I was on a call yesterday with Federal Student Aid. They have not heard anything about extending it. My guess is that they may extend it, and emphasis on the word may. Don't take it to the bank. Don't bet on it. But I know that with elections in November, I think the last thing they want to do is put 40 million loan borrowers back into repayment. So, my guess is that they probably will, but my suggestion is prepare for that restart. And especially if you're part of the way through that PSLF journey and you're going to have to continue making payments come September 1st, you're going to have to go back on an income-driven repayment plan. So you can start that paperwork now. You can go into studentaid.gov. You can apply for that. You can self-certify your income. So they've made it easy. You tell them what your income is. It's good for a year. So go ahead and just take care of that paperwork. So if they delay it, they've already got the paperwork and that's taken care of. There's also something called Fresh Start. If you know of anybody whose loans were in collections and default, they're giving them a fresh start, and they're hoping, I think in about another week or so, we're going to release some of the information about that. So that's good. Again, people whose loans have been in collections have had wages garnished, tax refunds. They're giving me a chance to restart, which will be a really good thing. But there's still a lot of questions about how they're going to get all 40 million borrowers back into repayment at the same time. So we'll see how that goes. And what maybe will compound it is that about close to 1/4 to 1/3 of borrowers have new loan servicers. I'm sure. So based on here, however many people are on here, probably good 15 or 20 of you. And it was the big ones. It was Fed Loan. Their whole portfolio is their portfolio was transferred to a couple different loan servicers. Navient, basically, they transferred their whole portfolio to another company, and they're now Aidvantage. And then Great Lakes, they're moving their loans over to Nelnet. So, and that was just announced. So my suggestion is to kind of keep up with your email on what's going on, and make sure that not only your loan servicer knows who you are, your current phone number, the best email that you get email messages on a regular basis. And I say that because I know some students, when they graduate, they get a college email and they continue to use that, but then they have another Gmail that they use. If those messages are going to that college account and you don't check it on a regular basis, there might be changes happening that you don't know about. The other best piece of advice related to that is to, again, go into studentaid.gov and make sure you have current login information, and make sure they have your current contact information. Because if the loan servicer can't reach you, they'll go back to FSA and say, do you have more up-to-date contact information for them? The PSLF limited waiver, and that's what I'll talk about in the end. It's been a great program that has opened up the option for a lot of employees in which they didn't have options. When I first started, I had state employees who were heading towards retirement, had their 10 years of service after getting a graduate degree, and come to find out at that point they had the wrong kind of loans. And the only solution at that point was to consolidate and work another 10 years, which wasn't going to happen. Fortunately, because of this limited waiver, I've been able to go back to some of those borrowers and said, hey, you're now back on track, and including one of those first borrowers, he's going to get his loans forgiven when he didn't think that was an option. The other thing is that there's a lot in the news about loan forgiveness. There are numbers being tossed around, 10,000, 50,000, blanket loan forgiveness. I wouldn't bet on it. because even I was reading this morning, there's concern from Congress about what authority they have. So they're still questioning about whether it's going to happen. Again, safe bet, don't plan on it happening. Just move forward with, loans restarting in September, get on that income driven repayment plan, get that paperwork done. What we've also seen is every time they announce a restart, there's been an increase in loan scams, and they're really good. Their emails that they send, they take, they put the logo of the loan servicer on there. They get a phone number. Like there was even one, they were saying they were Navient, and Navient's phone number was 888 something. Theirs was 800 and that same number. So they're really good at it. And they're doing one of two things. There's the quasi legal approach. And essentially what they're doing is that they're reaching out and saying, oh, well, we'll get you guaranteed loan forgiveness. Just, give us access to your account. And what they're doing is basically they're putting your loan into forbearance, switching over to an IDR. And there is income driven repayment loan forgiveness after 20 or 25 years. But they're charging a fee to do that. Just like maybe when you filled out the FAFSA, there were some of those same scammers that would do the same thing. Pay us and we'll do the FAFSA for you. Well, the first word in FAFSA is free. And same with the loans. Your loan servicer, it's a free service to you. Yeah, and so just make sure that you don't do it. The ones that are a little bit more sinister are the ones that get access to your username and password, and they'll go in and they'll change your mailing address, they'll change your email address. They'll say, oh, send the payments to us and we'll forward it along. Well, they don't. They keep the payment, and it's 3 or 4 months before you even realize that you've been in forbearance and that money is gone. So again, just be mindful. You're going to get a lot more phone calls about help with student loan. And I'll be honest with you, your loan servicer or federal student aid, they're going to send you an email. They're not going to call. I mean, unless they've been trying to reach you. And if somebody calls, say, give me a number and I'll call you back, or go directly to their website. The emails that they send, it's a fake URL. They're sending you somewhere else. So that, make sure you definitely know who you're talking to. Okay. And finally, and I'll pause after this, we'll get into loan forgiveness. There are other options that are out there, and they're all still available. And so I'll focus the rest on public service loan forgiveness. But let me pause at this point and see, because I see some numbers pop up in the Q&A. Is there any questions at this point?
Yes, Scott, we've got 2 great questions that have come in. One of the first questions was in reference to the Fresh Start program. Is that going to apply to loans that have been refinanced? If you know.
And I'm assuming they're talking about refinanced into a private loan.
This question didn't specify.
Okay, because for federal loans, it's consolidation where you put all your loans together, and it would. The Fresh Start is for loans that have been in default and collections. If you refinanced even a defaulted or loan and collections into a private loan, there's no way to bring it back. Unfortunately. So if that's when somebody says refinance, I'm assuming it's because you can refinance your federal into a private loan for a lower interest rate, but you lose all federal benefits.
Right. So for this discussion, then we are focusing on the loans that are still federally held, not with a private service. Yep. And then we did have another question about a group called GradFin. Do you know if this is a
GradFin?
GradFin. Is that a federal loan?
I don't know. They're not a federal loan servicer. And I know the names have changed, and I have a hard time keeping up with the ones that are currently active, but GradFin is not one of them.
Okay, I'll take a look just to make sure and follow up with that individual as well. Great, thank you.
Okay, good question so far. And I know I kind of gave you a lot, but I wanted to give you some background before we delve into PSLF. Both. I mean, all of you know other people that have loans, and I would hope you would share this information, and you can become the new expert in your little circle about it. And if your only expertise is contact Scott Kemp, the student loan advocate, I'm more than happy. My job is to work with Virginia residents. So it's not even if they went to an out-of-state school, or the person, as long as they're a Virginia resident, I can work with them. If they're not, you could probably still send them to me. I have colleagues in about 15 other states, And because I get a lot, but fortunately DC and Maryland have, I have a counterpart there. And because people live in one and work in the other, we're always trading cases back and forth. But I'm happy to kind of point those people in the right direction. Okay, so public service loan forgiveness. Again, just a quick overview of it. 4 main components: have the right kind of loans, make 120 payments. People often say it's 10 years. Basically, it's 120 payments while working for an eligible employer and being on the right repayment plan. So these were all the components that were in place prior to October 2021 and will be in place after October 2022. Okay, so I just want to give you that, and then I'll talk about what the limited waiver has done for that. So essentially, any loans since 2010 have been the right kind of loans. The ones that aren't would be like FEL loans or Perkins loans. Those are their federal loans, but they don't qualify for this program. It does not include private loans. And if you consolidate your loans, that restarts the repayment count. So just kind of keep that in mind. I know some borrowers, maybe they did their undergraduate, they paid for a couple years while working for an eligible employer, went back to grad school, consolidated all of them together, which might have been a good idea, but prior to this limited waiver, it impacted eligibility for this program. 120 payments, they don't need to be consecutive. If you were on bi-monthly payments, you need to make sure that both payments add up to the required amount for that particular month based on the retirement plan that you're on. And that you should be getting a payment count of it. And I always make the recommendation that, moving forward, again, if you're not close to the 120, if you're working towards it, set a calendar reminder once a year, fill out that employment certification form, take it to HR, have it turned in, because you can look at the previous year's count. And in theory, if you do it a year later, that count should have gone up 12 months. If it isn't, then you need to look into it and say, okay, what's going on here? Why are they not counting it? Right kind of job, you work for VCU, it's right. But if you worked somewhere prior to VCU, that counts as well. It doesn't all have to be the same employer. And even if you work part-time with multiple employers, I know, young graduates often have to work part-time a couple different places, but if both of them are eligible employers and you worked at least 30 hours, then definitely turn in the paperwork for those as well. And again, it's government, it's 501c3, it's not-for-profit organization, so that count. Just a couple cautionary measures, as I mentioned, send in that ECF once a year, monitor that payment count. If you worked at a religious organization prior to that, that's not a 501c3, that they do count. But if part of your 30 hours was preaching or proselytizing, then that doesn't. So you could, if you work, let's say 32 hours in the office and then did stuff above that, that didn't count, you'd still be fine. So again, I'm just making sure that don't just look at your service at VCU or state government or local government, kind of go all the way back. And this goes back to 2007, all the way back there. So look at your employment back to 2007, because you might already be at the 120 and not realize it. Be on the right kind of income, the payment plan, and it's those 4 income-driven repayment options. You need to be on one of those once payments restart in September if you're not at that 120. And suggestion is just go ahead and do the paperwork now. You can self-certify, which means you can tell them based on what's on your paycheck what your annual income is. And I might make this suggestion because state employees are about to get a raise come July 1. And my suggestion would be to self-certify before then. It's legal. Don't worry, I'm not telling you to do anything illegal, because at the time when you tell them what your income is, that was the case. So maybe before the 5% hits, fill out the, I just thought of that tidbit of advice. You might want to get self-certified before your income goes up. And then that's good for a year. So even once your salary goes up, or maybe you get a promotion at work, technically you don't have to let them know that your income has changed until you recertify a year later. If your income goes down, you can recertify at any time. So let's say you change jobs and you take a pay cut to do it, and you're not at that year mark, definitely go ahead and certify with that lower income. Okay, so limited waiver. I think that the stuff before was fairly cut and dry. The limited waiver was created because over the years, the loan servicers, federal student aid did a poor job of advertising or talking about what the components of the program were. So they weren't telling borrowers who had the wrong kind of loans, you need to consolidate in order to qualify for this program, or they were pushing them into forbearance, or not getting them into the right repayment plan. And so what they've decided is they announced last October that for 1 year, they're going to waive all requirements except working for a qualifying employer and not being an in-school deferment. So just to be clear, if you work for a qualifying employer since 2007 and you weren't an in-school deferment, then most likely they're going to count those months towards it. Now, I will say that this limited waiver, as they've rolled it out, it's been very bumpy. It has changed on a regular, and their FAQs that they have on their website keep getting longer and longer. And people are getting sent revised payment counts that are still not at the level that it should be. And the best thing I can say is just be patient about it. They're working their way through it. It's just the letters that they send aren't very clear that this isn't the final number. That is essentially they send you a draft payment count. This is based on the rules that we have looking at right now. These are the number of payments that you have. You're welcome to if you get a number that's way off, you're welcome to reach out to me to take a look at it. But I can tell you that they're in process. In order to qualify for this limited waiver, they have to know you're working towards PSLF. And the way you do that is either you fill out the whole PSLF application, which includes the employment certification, or you fill out at least one. Like the employment certification form is just a one-page thing that you get, and you take it to HR, they certify the months that you've worked. If they know you are working towards PSLF, they will look at your loans again. And particularly, let's say, you've been working at VCU since 2007, you consolidated in 2014 to new loans, which under the old rules, you restarted your count. Well, they'll go back and your count will be 2017 until now. They'll look at those months or those years prior to the consolidation. So that's the part that's taking a little bit longer. If you've had the right kind of loans, been on the right repayment plan from the start of your qualifying employment, it's pretty smooth and pretty clear cut. And so they're working their way through all the different exceptions that are out there. The loans must be a direct loan. So even if you have a FFEL or the wrong kind of loans, at this point, they're having borrowers consolidate. And if they tell you you need to consolidate, it's okay. It's no cost to you. You consolidate, and so that they can then discharge your loans. So just it's not a scam. It's not they're not trying to delay the process. It's just by law they can't discharge the wrong kind of loans under this program. So they'll have to switch you over and then count everything prior to the consolidation. If you are not at the 120 payment count at this point, even after they've looked at all your months, maybe you started working in 2015, but you had the wrong loans until 2018, a wrong repayment plan, whatever is your qualifying payment count as of October 2022 under the limited waiver rules will stand. So you basically will start over come September. Let's say they say you have 80 payments, and as long as your September payment is on an income-driven repayment plan and you have the right kind of loans at that point, moving forward, you'll start at 81, 82. In other words, even though the waiver will stop, any payment count that you had prior to October will continue moving forward. And one last thing is that all COVID-related payments count towards loan forgiveness. So anything, any month since March 2020 will count. So in theory, all the way up until August, which is the end of it, that's about I did 30 months that will count. So about one fourth of the program of your qualifying, it could have been based on not even having to make a payment, which is great, and that does all count. Now, I will say, if you made payments during that time period, because I know that there was only about 5% of the loan portfolio that chose to opt out of the forbearance and keep making payments. If you made payments during those months, then you should probably ask for a refund, because those months will count regardless of whether you made a payment or not. So it's in your best interest to get a refund for those payments that you make, because the $0 payment will count. Because again, that adds to the amount that you're going to get forgiven. And I've had a couple borrowers that have been able to do that. So that's a little bit of a sticky situation, or tricky situation. And I'm happy to help with it. But they know that, I mean, there were good conscientious borrowers who were making payments during it because they wanted to pay down the loan and not realizing that they didn't need to, and they would still qualify for public service loan forgiveness. Okay. Questions so far?
Scott, we've got a lot of questions coming in, and I think quite a few of them are related to kind of the VCU specific experience that Jesse, I think you are going to touch on here in just a moment. So I think we might save what I have got for the Q&A portion just at this point.
Okay, good, because I only have 1 or 2 more slides.
Great. Yeah.
One other wrench that they've thrown into it, and it's a good wrinkle, but if you've heard anything about the income-driven repayment forbearance steering, essentially you as a borrower would call up and saying, I'm having trouble making payments. The loan servicer would say, oh, well, let's give you a 3-month forbearance, because that's a 2-minute conversation versus the 15, 20-minute conversation about an income-driven repayment option that would have been in your best interest. So rather than go through and just kind of look at each individual person and have them make a case for it, they've just decided that they're going to go through and look at, if you had 12 months of forbearance or more consecutively, if you cumulatively had 36 months of forbearance, or you had deferment or forbearance prior to 2013, and again, not in-school deferment, that was the choice. They've really kind of drawn a line on in-school deferment as not counting, then you'll get some months counted towards that IDR loan forgiveness, that 20 or 25 years. The good thing is that it's also that same review is helping PSLF borrowers. So, I mean, let's say you were working for an eligible employer, but you took 12 months off from making loan payments because, I don't know, some life situation came up. There's a good chance that those payments will not count under this new forbearance steering review. So that's just, but it's going to take a little time. And again, that's why when I say you get that payment account and it doesn't look right, just kind of wait and see. I mean, you're more than happy to reach out to me, and I can kind of look at, in fact, if you reach out to me and send me a copy of that letter that you got with your payment count and just tell me briefly what your employment history is, I can kind of say, well, it's probably because they're still looking through it. So this forbearance steering review will also help, but that's when I understand that it's going to be into the summer and early fall before they finish for those reviews. And finally, is PSLF right for you? I mean, it's a good question to kind of consider. As I said, the goal is to pay as little as possible to get the most amount forgiven. But there are situations where your income might be too high. In other words, that income-driven repayment that they're saying based on your income might be higher than the standard payment. And thus you may end up paying the loan off faster than the 10 years under that. Or your loan amount might be too low. And that's where that loan simulator that I mentioned, it'll let you know, based on the amount of your loan, the salary that you have, what amount potentially will get forgiven at the end of it. The other thing is that if you're thinking about maybe not spending 10 years in public service and going to the private sector at some point, just keep in mind that income-driven repayment it lengthens the amount of your loan and the amount of interest you pay over time. So if you don't think that you're going to stay in public service for 10 years, then it may not be the best option for you, that you may just want to get on that standard and pay it off. However, let's say you go away for a year and you realize, oh, I miss VCU. I loved it so much there. I want to come back. You had 60 payments. Well, when you restart at VCU, you start at 61 and then 62. So you can restart where it's. So even if you decide to take a break from it, maybe get some more life experience to help benefit VCU, you come back, then you pick up where you left off. So that's where hopefully that was a good enough overview, and we're happy to share the slides with you on this. But now let's move into the questions and see what comes up.
Yes, perfect. I think, Jesse, would you share your experience from navigating this process yourself as a current VCU employee? Because I think for a lot of the questions that we're seeing right now, it is specific to working at VCU and navigating this process. And then I have a few other questions I think that are broader that we can touch on and bring Scott back in.
Sure, yeah, I would be happy to touch on that. So I think one of the things I want to highlight that Scott mentioned is when you're making the decision on whether or not you want to pursue public service loan forgiveness, when you make that decision, it's really important to kind of understand it as a dichotomy. Either your goal is to pay off your loans as quickly as possible, which will result in you paying, as much as possible per month, or your goal is to get some sort of loan forgiveness, which is going to require that you pay as little as possible. So right now, during the pandemic national emergency loan suspension, payment suspension, you shouldn't be paying anything if your goal is forgiveness. So kind of understanding it as that sort of dichotomy. We've gotten a couple of questions on consolidation. So I'll just touch on something that Scott mentioned, which is, of course, that when you consolidate, you're actually creating two brand new loans. And those brand new loans don't have any payments on them yet because they're new loans that are created to pay off your old loans. So that's logistically why the count resets. So if you haven't worked in public service then at all, then you're fine to consolidate prior to working in public service. But if you have been working, making payments that you may or may not know are actually qualified payments, you want to be cautious with consolidation because you may have payments that are considered qualified payments. No one's just been counting them yet because maybe you haven't completed an employment certification form. So for anyone that's interested in this, my recommendation would be to submit an employment certification form. So that way they can give you a count and you could be pleasantly surprised where a number of your prior payments are actually qualified payments that count towards those 120 payments that are needed on each individual loan to get that loan forgiven. Somebody asked a question earlier on, what happens if some of my loans are paid off and some of them aren't? Well, the count is for every single loan. So submitting your ECF, which I would recommend doing that yearly. That's how often I do mine is once every year, right around tax season. It's a good reminder to do that. And then, you'll have your HR representatives sign that. So every VCU employee has an HR representative that they can go to. The one thing I do want to touch on with the ECF, though, is that the Department of Education and the loan servicer is very strict on what can be accepted. So when you're having that ECF completed and signed by HR, you definitely want to make sure that it is a wet signature. Because we've had a lot of instances, and I can speak on this on behalf of myself, where the form was docu-signed and it got rejected. The form was signed using a touch screen like an iPad, but it's noticeable that it's not a wet signature. That got rejected for me as well. So in today's remote environment, you might have to connect with your HR rep or send it in interoffice mail to have them sign that. But they are pretty strict on the signing requirements. So yeah, you definitely want to do a ECF every year. And if you haven't done one yet and you submit it, the worst thing that's going to happen is, you're going to get it back realizing that you haven't made any qualified payments for one reason or another. But submitting that ECF is not going to put you in a worse off situation. And Scott can correct me if I'm wrong, if there's any other sort of implications that I might not be thinking of from the borrower perspective. But I think one of the most important things is definitely submit that ECF often. I did answer this in the chat, but VCU is a qualified employer, as is VCU Health. You do have to be full-time. And Scott, you can touch on this. I can't recall if the feds define full-time employment as 30 hours per week or 32.
Well, full-time is defined how the institution defines it, or at least 30 hours a week. Yeah.
Thank you for that. So, if you are adjunct, then that would really be up to your HR representative. who's signing off on the form. They will provide you information as to why they can or cannot, because they will have to certify your level of employment. So, we get the ECFs from time to time in the financial aid office. Please be sure to direct those to your HR representative.
With respect to the adjuncts, if you adjunct at more than one institution, 3 or 4, make sure the HR director knows that, because they're going to read the fine print on it. Says, well, you didn't work 30 hours here. Make sure they know, well, I worked 15 hours here and 15 hours at Virginia State, and that adds up to so make sure they know. They're going to be hesitant about it, and if they need to reach out to me to confirm it, but yeah, just make sure they understand that.
Thank you, Scott. Yeah, that's definitely an important highlight. And that's about it for my kind of experience. Carolyn, if we want to move into questions, that's totally fine.
Yes, Jesse, thank you for providing kind of the user experience side of things. Scott, thank you for giving us the bird's eye view and all the details related to this program. So we're going to attempt to answer all of these fabulous questions that have come in. And if we don't get to your specific question, we've got contact information that I've been putting in the chat. This recording will be available to you, as well as all of our contact information will be sent out from Human Resources at VCU as well. So you can follow up with any of the folks that you see here on our webinar today. The first question, and I've seen this in a couple different variations, is from quite a few people, is looking at how to start this process, next steps. Are we going to consolidate with the federal loan servicer for PSLF, which is changing to MOLA or MOHELA? MOHELA. Thank you so much. I appreciate that. So do we consolidate with MOHELA first and then submit an ECF, or do we do an ECF and then consolidate?
The current recommendation is go ahead and get your employer certified first, and make sure that you've got the months in that clear. And then, your foot's in the door, because the consolidation process can take a couple months. So, make sure the ECF is, and most likely it'll come back, it'll look at your loans and say, yes, you have a qualifying employer, but no, you need to consolidate. And the other reason I mentioned that is that there's been talk and inkling about possibly forgiving loans without doing the consolidation. So let's wait until federal student aid tells you, yes, you have to consolidate first.
Excellent, thank you. Another question, and Jesse, maybe you can speak to this, is once you've submitted that ECF, what happens next? How long did you receive confirmation? Sure. Where do you go to see your payment count, that type of thing?
So we're in a little bit of a transitionary period with student loans for several reasons and several aspects. One of those is federal student loan servicing. So the current servicer that's tracking public service loan forgiveness qualified payments is FedLoan. There are several federal student loan servicers, but the company FedLoan has historically been the only federal student loan servicer that has tracked and kept account of public service loan forgiveness qualified payments. So what that process has been like is you submit your employment certification form, and if your loans are not currently with FedLoan, they will be transferred to FedLoan, or at least. Go ahead, Scott.
As I heard yesterday, they're gonna stop doing that because FedLoan is getting out of the business. But no, you were right. Up until yesterday.
Yep. So like I mentioned, FedLoan was we're in a transitionary period, was the counter for qualified payments, but MOHELA will be the federal student loan servicer for public service loan forgiveness tracking. Moving forward, Scott, based on your meeting yesterday, you may have more information on when that time frame is, but what I will share from a borrower perspective, and someone mentioned this in the Q&A chat already, is that if your loans are with FedLoan, you may be getting a notice saying they're going to be transferred. I just got my notice, I think this past week. But the process is you submit your ECF, and if your loan servicer is not a public service loan forgiveness servicer, your loans will be transferred to whoever is, whether that be previously FedLoan or moving forward MOHELA. Generally speaking, though, if you haven't completed one of those before, it does take some time, in my experience, before you're going to get a response. If your loans have to be transferred, that's going to extend that time, likely, at least again, in my experience as a borrower. But I actually just submitted my annual ECF last month, and I still haven't received an updated count, but that's likely because of this odd transitionary period that we are in right now. But in theory, you submit your ECF 30 to 60 days, I would say, you should receive a notification back listing the count of qualified payments. And I would recommend doing an ECF annually. That way, you can definitely retain those. Any sort of communication you receive from your loan servicer about public service loan forgiveness, retain that documentation. And year over year, you should be able to see your qualified payment count increase by 12. But that's kind of my experience. Definitely do it often. And we are in that transitionary period for the servicing of public service loan forgiveness. Scott, did you have anything that you wanted to add?
No, so if Fed loan accounts that were not working towards PSLF, they transferred them over in the spring because those were the easy ones. They've kind of held off because they're trying to do this recount, this waiver count before they move them, because some of them are going to get discharged. So they don't want to move them and then do the discharge process. But they're now at the point where they're probably in another month or so all will, and most of them are the PSLF ones are going to Mohila. There's a few that are going to like Nelnet, which is one of the other ones. But Mohila is good. They over the years, I mean, they've done audits of customer service of the loan servicers, and Mohila has always been highly rated. And we're fortunate that the Virginia Financial Aid Administrators Association, we have one of Mohila's main guys on there, and I've had great conversations with him, and they're legit. So if you don't get good service from them, let me know, and I'll let Will know, and he'll get after them.
Great to have someone in our corner. So thank you so much for that, Scott. Another question that I'm seeing recurring is about past payments, how to certify previous employment, previous years at VCU, and also related to this transition to Mohila, if their current servicer is Mohila, what do they need to do?
Yeah, so the PSLF help tool is probably, if you haven't done any of this before, and this is your first time going into it, that's probably the best, because you log in and it knows what your loans are, what type they are, and would know what error. It knows that VCU is a certified employer, but the one caveat, and it'll auto populate the form that you're going to take in. The thing it doesn't do is if you work for multiple employers, then it's not going to give you extra forms. So you're going to have to print off new forms to be able to take that to the other employers that you have. But my suggestion is just go ahead and try to get those employer signatures as quickly as possible. But if you've got some from maybe a nonprofit that you worked for 7-8 years ago and you're still trying to track them down, go ahead and send the application, get that working, and then you can always send that other thing later. If you worked for a company that no longer exists, let's say it was a nonprofit that closed, you worked for them in 2010, they closed in 2015, you can self-certify that employer. You'll just need copies of your W-2 from that time there. So if you can't find the employer, don't give up, because what we're also finding is now that they're going back to 2007, that's 15 years of potential payments that people made. If you made payments, once they decide this was your 120th payment, if you made payments after that, they're giving people refunds. And I've had people get $5,000, $10,000 checks from payments they made above the 10,000 or the 120 payment count. So it may seem like a hassle to get that old employer certified, but it could be money that's coming back to you.
I can speak to experience there. My stint at UVA from 2007 to 2009 just showed up on my count of eligible payments and I had to send in a form over to UVA HR to get it signed off on. But that is something that actually happened for me. So thank you for that, Scott. We have got quite a few more questions coming in. So let's see. We have a few people who have graduated in the past couple of years. So these loans have been frozen and $0 no payments have been required. And they had their, of course, their grace period for after graduation. So what would be their next steps in looking at this particular, starting the PSLF process and starting the repayment process?
Yeah, and I see one that specifically asks about, should you consolidate now?
Mm-hmm.
Technically, under this limited waiver, when you consolidate, it restarts the count. Technically, it won't. But at this point, if you graduated a year and a half ago during the payment pause and you haven't consolidated, I would just not worry about it. The only reason you might want to do it, because when you consolidate, they take an average of the interest rate. So if you do the math and you realize maybe the majority of your loans that you took out in a particular year were at a higher interest rate, then it's gonna if you do the math and just you're the tax person, it might work in your favor. But you don't have to consolidate to continue on with the program. If you graduate in the last couple of years, I guarantee you have the right kind of loans, unless they're private, that you have the right kind of loans. And what they'll do is if you have one loan from each of the 4 years, and subsidized and unsubsidized, you're going to have 8 loans, and it's going to give you 8 payment count or a payment count for each of those different loans. Similarly, if you do undergrad, work for a bit, go do grad school, you don't need to consolidate. You'll just have some loans that are going to get forgiven faster than the others.
And on that topic, Scott, one thing to add is if we have anyone who has undergraduate loans and is thinking about going back to grad school, the one thing that to keep in mind is when you are in school, to some extent, your loans are automatically put on an in-school deferment. Mm-hmm. That period in which you're in an in-school deferment, even if you are in a graduate school program but working for VCU full-time, if your loans are in school deferment status, then any payments that you're making during that time are not qualified payments. So my recommendation is to actually, this is what I did, and Scott, you can speak to the your end of it, but is to waive your in-school deferment. That way, the payments that you are making are actually counting towards those qualified payments. So for individuals who borrow at the undergraduate level, and then again at the graduate level, you might see a sort of trickling effect of your forgiveness because your undergraduate repayment started sooner than your graduate repayment. So that's one thing that you can do to kind of help yourself with the public service loan forgiveness. Or I should say that will allow you to yield the greatest PSLF benefit is to waive your in-school deferment, if of course you can afford to do so, because then you'll have to make payments during that time.
Yeah, if you can afford to keep making them, then definitely do, because that keeps the count going. I will say, even though you tell them you want to waive it, check every month, because they will continue. Yep. They will keep putting you back in school deferment. It's that for some reason telling them once isn't enough. They're like toddlers in that respect. You just got to keep telling them, no, I don't want in-school deferment. No, and so you just have to be vigilant with it.
Couple last questions with the few minutes that we have remaining. And if we don't get to your question today, again, please, we'll send all of our contact information out in a follow-up email along with the recording. So please reach out to Scott or Jesse or myself. If you are having trouble with a previous employer signing the ECF, what is your recommendation?
You can self-certify, like it. Yeah, if they refuse to do it, or as I said, they don't exist anymore, they are allowing you to, and there is a process to do that. And I believe it require, you'll have to submit a W-2 form for those tax years that you did that. Mm-hmm. But there is a way around it. Just because you can't, or the employer won't sign it. And in some cases, if you left on bad terms as an employer and don't want to go back, that's fine. But you'll still need to, I think, submit your W-2s.
Yes. And for the information related to filing taxes and how that affects the income-based repayments, how you file, married filing jointly or filing as an individual or married filing separately would impact the income-based repayment. Is that correct?
Yes, but there's one caveat, and I believe I have to double check. I think it's income-based repayment. If you do married file separately, then they'll only look at your income to determine what your amount is. Now, if you both have loans, it doesn't matter because they'll look at both and they'll know. And if you tell them, your spouse doesn't have loans, eventually it'll catch up to you because they do the check with the IRS on that. But I believe it's income based. If you're married, filed separately, it'll only count your income.
The other thing to point out, and I want to phrase this by saying I'm not a CPA. This is not tax advice. However, there are some tax credits that if you file married filing separate, then you actually cannot claim those, such as the student loan interest deduction. So for the purpose of student loan repayment, it may benefit you to file married filing separate because it's only considering your income and not your spouse's then. There are other reasons why you may still want to file married filing joint. So it's definitely something that you have to weigh kind of the pros and the cons. But as Scott mentioned, if you and your spouse both have student loans, then married filing joint is fine because your payment's proportional to the amount of debt that you have.
And I see the one last question you have up there, and that's a good one to kind of end on. So previously under PSLF, you had to be working at that employer when forgiveness was granted for you. So if you worked 12 years under the wrong loans and you've now retired, you were out of luck. Under the limited waiver, you no longer have to be working for that eligible employer to get forgiveness. So the answer to that question is, if you have the 120 months of eligible employment payments, go ahead and fill out that employment certification form, fill out the application, and they'll go back and review it. And hopefully, if you've already got that 120, then you may have some forgiveness coming your way.
Thank you both so much for all of this information. I know we didn't get to every single question today, so I want to thank our audience as well for just being so engaged and coming in and trying to get all of this figured out. We know this is a complicated process and it can be a little daunting to get started, but we are here for you. We will be sending out the recording for today, contact information, and some of those helpful links. So please keep an eye on your email for all of that information. And again, thank you so much to Scott and to Jesse for coming and providing their expertise and experience with the PSLF process. So have a great afternoon, everyone, and thank you again for joining us.
All right, thank you.